And I'd like to welcome our finance and wealth gurus, Sarah Blake and Zeb Ashton, who are here from William Buck, who are also very generously sponsoring today's event. Good. And they're going to be talking about planning your financial future.
It's all a bit different to what I expected. Thanks everybody for joining us today. I'll just get myself so that everybody hear me okay? Thank you. So today we're going to not focus on all of the elements of personal financial planning and planning your future, because that would take a lot longer than the 20 minutes we've been allocated. So today we're really going to focus on two areas. Protecting yourself through personal insurance, which we view as a critical way of actually protecting yourself as you build your wealth and you plan for the future. And then as a bit of a strategy aside, we're going to also talk about superannuation, which is probably the most relevant strategy that you'll be looking at this stage in your careers. So what we have here is really a table of what the wealth accumulation stages tend to look at and the priorities that you have. What we've circled there is really what we're aiming to talk about today. And really there's three elements of all of that, which brings together what most people in this room might have their focus on, and that's career and building it, family and looking after it, and your mortgage and bringing it down. They tend to be the focuses for a really large part of your working lives. If you're lucky enough that you have some form of surplus income or you have some other resources available to you, then you look at wealth creation, but all of those three things remain important. So why do we plan? I think we've all heard about it. It's really to make sure that we have enough assets on the table at the right time in order to support you through retirement. So we have some numbers there that the average superannuation balances for people who are in their 60 to 65 are quite low, and they're not really going to provide a great lifestyle above the age pension. So when we look at what you might like, and most of you over your careers will earn a lot more than the average person, you'd probably like to keep that lifestyle, particularly if you do eventually retire, which I know medical professionals don't tend to like to do. And so what do you need? So typically the rule of thumb is if you want $50,000 worth of income, you need around $1 million worth of assets to comfortably support that. So that just shows that we can't, while we are focused on family, career and mortgage, you do have to keep a bit of an eye on the future. So we do have the strong elements of the plan. One thing that really should be there is protection of the plan, but it's the best things is optimization of your after-tax cash flow, use the structures and the correct ownership to build your wealth, and keep an eye on your investment strategy. So how do we protect it all? So we view personal insurance as a form of wealth creation. It doesn't directly create wealth, but it protects it and protects your ability to create it. So if we bring it back to those three things, the career, family and mortgage, those are the things that you want to protect. And virtually most people need some form of personal risk insurance. So there could be different reasons. For those who don't have family or don't have dependents, you want to protect your own income and make sure that your own lifestyle is protected. So some form of disability insurance is important. But then again, those who do have dependents and do need to look after people, you really need to make sure that you have your lump sum insurances in place. So what's at risk? So basically everything from a financial perspective if you were to suffer a major disability or pass away. So we have your mortgage, other debts, your living expenses, and that's not just your living expenses, but also those of your family if that's relevant to you. Your ability to save, that can't be underrated because you might be able to get through a period of a disability, but if it really holds you back from creating wealth over time, or if you lose your home, then that can have a major impact on your future wealth. So what do we have available to us? We have really 4 main types of personal risk insurances in Australia, which really cover most of the medical events that could happen to you, or major medical events that could happen to you. So the first is life, which is really death cover. And that's insurance that is pretty familiar to most people, and it pays a lump sum should you pass away. Generally, you have that type of insurance in place if you have somebody to look after after you pass away. Generally, we would structure that within super, or we could do it outside of super, depending on your circumstances. Another critical thing, particularly if this is for all people, not for just for those with families, is the income protection insurance. So income protection pays out an income stream, so it replaces salary up to about 75% of your insurable income. And it also pays out on a temporary basis, but also a long-term basis if you suffer a career-ending disability. It's there to replace income, and we do tend to structure that outside of superannuation, and that's because there are some legislative quirks about accessing superannuation if you have a temporary disability, but also income protection, whilst it's quite expensive, is also tax deductible. The third one is, I know it more as trauma insurance, but it tends to be known as critical illness insurance. It pays you a tax-free lump sum on the diagnosis of a particular medical event. So most claims tend to be around cancer, heart disease and stroke. But most policies these days do cover a substantial amount of different conditions, and they tend to evolve over time. A lot of them because the insurers are getting burned. So for example, a lot of old trauma policies used to cover things like type 2 diabetes. Now they realise that wasn't such a good idea because they ended up paying quite a lot of money out to people who weren't really that sick. The final one is total and permanent disability. So it's the one that comes into play if you are disabled to the extent that you'll never be able to work again effectively in a job that's appropriate to you by your training or background. So that is split into 2 different types of insurance. So you have any occupation, which really is about any occupation that you're suitable to, so it can be a quite wide range. And then there's own occupation, which is what we tend to recommend for medical specialists. So why do we need to protect ourselves? We do have a case study of Dr. Julie. Dr. Julie is a specialist at Alfred Hospital. She's aged 35, is a non-smoker and good medical history. She's earning a really good income of $200,000. She's married and is the primary income earner for her family. And she has twin 8-year-old boys, and they have got a relatively comfortable mortgage. So really, on the face of it, Dr. Julie's in a fantastic position, and so is her family. But unfortunately, Julie has a car accident and passes away. So what are the financial consequences? They're pretty major, to be honest, because in this particular case, her partner doesn't earn $200,000 a year. And so things overnight change pretty dramatically. So her family would be unable to support the home loan and must sell their home. They would lose the choice of where to educate their children based on their ability to pay. The lifestyle in general is changed significantly. And on her partner's side, they're not earning as much, lose the ability to secure their own financial future. So obviously we have a better alternative. So if Julie did have some life insurance cover, the family could retain their home and pay down their mortgage. They could create an investment portfolio that could earn income for them to support their lifestyle. And then the financial future of the partner could also be secured depending on the objectives of when you go in to apply for insurance. And I'll note that this is just a life insurance claim, but other insurance could protect Julie and her family in case of a major disability. So how much cover does Julie need? And this is a question that we do tend to get asked. So if we did a very basic needs analysis for her, you'd at a start want to pay down her mortgage. You'd want to support the educational choices. That could be something that you decide not to do, but in this case, Julie and her family did. You'd want to support living expenses, and I did a little calculation of how much she could actually afford, and that was around $68,000 per annum. So for that amount, we needed just over 1.35 million. And then we just had some other expenses, for example, funeral or medical expenses. So it's actually quite a large amount of life insurance needed to support her in this situation of $2.3 million. So to give you an idea of how much that would cost, now Julie's quite young at 35, and so life and disability insurance tends to be reasonably cheap. As you're aware, it gets more expensive as you get older. But you see, it's quite a large amount of insurance there, but it's not really that expensive. And in this particular case, you could structure that through insurance. So in her particular case, an average premium was around $686 per annum. The income protection is significantly more expensive, and that's related to the fact that she has a very good income, and we're protecting 75% of that $200,000, so $12,500 per month, with a 90-day waiting period. So there are different waiting periods that you can select, from 30 days right out to 2 years. And we've elected to insure Julie until age 65. So that costs over $2,000, but you do have to remember that this is tax deductible. So therefore she is able to cover almost half of that through her taxes. We have critical illness. So this tends to be more expensive as you get older. It's still reasonably cheap at this stage. It's not tax deductible because it pays a lump sum at the end, which doesn't get taxed at all. And that came out at $564. And then finally, the TPD, again, reasonably cheap because it's pretty unusual for a 35-year-old to suffer a disability that knocks them out for the rest of their career. So we took $1.2 million linked to the life cover. And the reason that's a bit lower than your life insurance is because you also have your income protection insurance in place to protect you. So the aim of this is not only to cover some medical expenses, but also set up a fund to help support Julie actually once she reaches age 65. And so the cost of that is $538. So I'll pass over to my colleague, Sarah.
Thank you, Zeb. Now, I just want to apologise in advance because I seem to have left my voice at home today. But if you can't hear me, just pop your hand up and I'll try and speak a little bit louder there. So I'm here to talk to you about superannuation today. And while there's a fair few in the room who probably don't think that superannuation is in the forefront of their mind, it's a fair way off. I'm here to really say and structure some of the plans here that you can put in place at an earlier age to make the most of your superannuation in the long term. So getting the basics right is crucial, and you can do that at any age, but the earlier the better. So we've got things like tracking down your lost super. There's currently about $17 billion of lost super in government accounts around Australia. So if you've ever worked in multiple jobs and you've never consolidated your super, it's highly likely that you could possibly have some out there. So it's very worthwhile doing a MyGov search or speaking to your accountant about tracking down that lost super and making sure it's coming back and earning money for you and not the government. So if you do have those multiple super accounts, I'd also consider merging them into one account. So a lot of insurance are standard on superannuation products. So you're possibly paying multiple superannuation life insurance policies. You're possibly paying a standard fee across the board on multiple superannuation policies. So you're potentially doubling up on a number of expenses, which is eating into the earning capacity of your superannuation balance. So consolidating them across is a good way to make sure you've got it all under one roof, managing it appropriately, and also maximising the earnings capacity of that as well. Now, having a review of where your super is invested is crucial as well. If you've never actually had a look at your superannuation plan, it's quite likely that you have a default option that may or may not be appropriate for you. Generally speaking, your default option would be a balanced portfolio. And that may be a sort of 50-50 mix of low risk products, which might be cash into term deposits, and that higher risk product, which might be your shares and portfolio assets that earn a higher rate of return. Now, if you're in your 20s, 30s, even 40s, your super is going to be invested for a very long time from there until you actually start accessing it, and potentially another 30 years from then until it actually finishes up. So your strategy at an earnings stage of your lifestyle would be maximising the growth potential of your superannuation. So reviewing where it's invested and considering a strategy that is appropriate for you and that is earning a higher rate of income over that long period of time is crucial to make sure that you've got the higher balance at the end of it as well. Of course, it also comes down to your personal risk profile, and that's not suitable for everyone with that high income or interest and risk portfolio. So considering them and weighing all up your options is really, really important as well. The other thing is to make super contributions. Now, I don't know if many of you know that the laws had changed from the last financial year, and salary and wage earners were previously limited in the additional super contributions they could put in and claim a tax deduction for. They've now removed that legislation. So if you're not maximising your concessional caps, and so that's your contributions that are going in from your employer that are taxed within the super fund, or that you personally are putting in and that are taxed in the super fund, you can put in up to $25,000 of super contributions. So if you haven't maxed out that cap, there's the ability to pop in and top up and claim a tax deduction in your personal tax return as well. So it's just a way to start injecting some money into that superannuation, to start building up that portfolio from a younger age, an earlier stage in your life, to maximise the return on that investment over a number of years. So why superannuation? Why would you put that into superannuation versus other structures that are available? So if we take Dr. Julie, for example, she's earning a salary and she's earning about $200,000 a year. So she would be considered to be in the top tax bracket on her personal tax rate. So she's earning $200,000 and she's paying tax of up to 47% on that income. So it's a scaled system. So every dollar over $180,000, about 47% would be coming off. If she had a capital gain, she gets a 50% discount on that gain if she's held the asset for more than 12 months. And in that instance, she'd be paying tax at half her marginal rate, which would be the 23.5%. Now, companies have a lower tax rate than your individuals and are capped out at 30%. In some instances, you might have a 28.5% tax rate, but that's if you're meeting certain criteria for small businesses. And a flat 30% tax rate in the company is, yes, lower than your 47% you're paying personally, but if you're distributing that income out back to yourselves in the form of dividends, there's additional top-up tax required when it actually hits your account as well. And then we've also got trusts. So a lot of medical professionals use service trusts in their businesses, and a trust is effectively a entity whereby the income is coming in, your expenses are offsetting that income, and it's distributed according with the trust deed. Now, in Julie's case, if it was coming back into her personal name, she'd then be paying tax at that 47.5% again. 47% again. And trusts have the ability to access those CGT concessions because it flows through into your personal names, but you're still paying that quite high rate of tax of 23.5%. Now, if I compare these different type of entities to a superannuation fund, you can see where the tax savings really come into play. So a super fund in accumulation phase. So that's what the majority of the people, if not everyone in this room, would be in right now. You're building your portfolio, you're building your super savings, and any contributions you make and the earnings on those contributions are taxed at 15%. It's a flat 15%. So when you compare this to your individual tax rate, you can see it's a significant difference. When you then tip that member balance into pension phase, so you retire or you turn 65 years old, that actually goes down to nil. So you don't pay any tax on the earnings on that first 1.6 million of pension balances. So there is a considerable difference of why you might consider putting money into super now to save you tax in the long run, but also build up your investments. So I touched on contributions before. You can see this is quite an intensive screen. There's a number of different options around here, but very generally speaking here, most individuals will have a concessional contribution cap of $25,000 a year. Now your concessional contributions are contributions that are taxed in the fund, and either yourself or your employer is claiming a tax deduction for them outside of the fund. Now, the $25,000 includes your employer contributions, and it also includes those ones that you make personally and claim the tax deduction. And you are also limited on the amount that you can put in once you turn 75 years old, because it's limited to only your employer contributions that are made under an award. Now, you've also got after-tax contributions, which we also know as non-concessionals. Now, your non-concessionals don't have any tax on the way in, and they also don't have any tax on the way out, so you can't claim a tax deduction. You've got a cap of $100,000 in there, but you have the ability in some instances to bring forward that cap to put in up to $300,000 over a 3-year period. So you could do that in 1 year, or you could spread it over the 3 years. But there's also limits in place depending on your super balance. So it's really, really important that if you're looking to make additional top-up contributions, you just have a chat to your accountant and have a review of what's currently going into your fund. So I'll just touch very briefly on the different types of superannuation products there are. We've got your industry and retail funds, and so they're the most common type of funds. So you might probably be in something like a HESTA product, and that's an industry fund. So an industry fund and a retail product generally won't have any costs of entering the fund, but they pay a percentage rate on your balance of that fund, and you pay that as fees. And then you have insurances that are coming out on top of that. For this instance, I'm not going to touch on the insurances because they're going to vary from every individual. But in this instance, I'm also comparing it to a self-managed super fund. Now, in all 3 scenarios here, I've got $1 million balance. And in my industry fund and my retail product, which are actually a one-path product and a Australian super product, we're paying a flat fixed rate of 8% on the balance and 0.8% on the balance for the Australian super fund, and 0.88% on the one path product. Now you can see there we've got about $8,000 in fees, between $8,000 to $9,000 in fees in both instances. On the other side, we've got the self-managed super fund. Now, self-managed super funds do have a cost to enter into them, because if you don't have one established already, you need to have a review of your personal situation, and there's a cost involved with setting that up. It's a one-off cost. Then as your balance grows, in this instance, we've got the $1 million, there's a flat cost. It's not a percentage, it's not tied to the balance of your super fund. It's a flat cost that you pay depending if you've got 500,000 or if you've got $3 million in there. Now that is at the discretion of the accountant, so please don't say take this product and go, oh, this is what this costs, but you're charging a different rate. This is just purely an example. But if we scale these numbers up and we've got $2 million in the next 10 years in these funds, you can see that your industry fund and your retail product would also be paying a much higher rate in expenses, in fees earnings for that period of time. So they would then go up to $16,000 to $17,000, $18,000 per annum in fees because the balance of their fund has increased as well. Your self-managed super fund, because it's a flat fixed fee structure, doesn't necessarily go up. So that was just a very quick summary from a fee perspective of that. I've also got a structure of it here. Now, your self-managed super fund is very similar to a trust structure. You've got your trustee. In our case, we've got a corporate trustee. And you've got your members who make contributions or rollovers into the fund. The fund invests in a number of different products. And the main difference with a self-managed super fund to an industry or a retail fund is the type of investments it can invest in. The biggest one being property. So you may find that medical practice has the owners purchasing their property in the self-managed super fund, or you can have your shares that are earning the franking credits, and you can have a portfolio of shares that you may not necessarily be able to purchase in a retail product because they're outside the ASX top 100, for example. So the self-managed super fund, while having a different fee structure, also has a lot more flexibility in the types of investments that you can purchase in it, and the way that they can retain earnings in it to pass it back to you when you do meet your retirement phase. So it's just a very, very quick little summary of superannuation. We've got a stand out there, so if you want to know anything else, please come and have a chat to us. We've also got a door prize, so if you want to pop your name and win a good food and wine voucher, please come out and have a look as well. Thank you very much, guys.